Hey, welcome to this session. In this video, we will see how to evaluate tax-free bonds given that an individual who is buying a tax-free bond do not have to pay tax, and a person who is buying a taxable bond has to pay tax only in coupons. How can you compare both these bonds and decide whether to recommend a bond to a client or not? This is something that all of us would be interested in knowing how to go about this process. So in this video, we will take an example of REC tax-free bonds and explain you how we can go about this process. Let's take an example. So this is an example that we are going to work with. This is REC tax-free bond, which is coming out in September 2013. Let's concentrate on the bonds that are going to be issued for retail investors. So this is 1B is one of the tranches that is meant for retail investors. The coupon rate is 8.26% per annum, meaning if you buy a bond for 1000 rupees today, every year you will get 82.6% as coupon or interest. On maturity, you will get your 1000 rupees back. This bond, the series 1B, is for 10 years. So with this small understanding, let's quickly recap whatever we have seen. Coupon is 8.26%. The initial purchase value is for 1000 and the final redemption value is also for 1000 and the bond is for 10 years. Let's see how we can go about analyzing this. This is the bond that we are going to discuss. The price of the bond, if you are to subscribe now, is 1000. On redemption, you will get 1000. Coupon, now we have to evaluate this bond against a taxable bond. So what is a taxable bond? Let's say how to find a taxable bond. A taxable bond can be found out by finding out AAA benchmark yield. AAA benchmark yield. One of the places in which it is available is in FIMDA. FIMDA discloses it. You can get it from CRISIL. You can get it from Bloomberg or Reuters. Or you can also get it from one of the research report, weekly research reports that come out. All the stock calls that we see, one of the weekly research reports you can find out. At this moment, a benchmark taxable bond is giving an annual coupon of 10.15%. That is similar bond with 10 years of tenure. Right? Let's assume an investor has 30 years of 30% of tax. So let's see how to evaluate this. So let's quickly recap. A taxable bond is likely to pay 10.15% coupon, and this bond is also for 10 years, and the tax rate applicable for an investor, for example, is 30%. So this is the bond that we are going to take for our purpose. So let's find out what is the yield on this bond. So the pre-tax cash flows of this bond will look like this. So initially you have to pay 1000 rupees, which is an outflow. So when we are buying a bond, we will spend 1000 rupees, so it is an outflow. So purchasing a bond is an outflow, so we are putting minus 1000. Post that, how much we will get is the face value of the bond, that is 1000 rupees, into coupon rate, that is 10.15%. This is what we will get as interest every year. So 1000 into 10.15% is what we will get as coupon every year, which is 101.5. So for 9 years, we will get this coupon of 101.5. In the 10th year, we will get this coupon plus at the end of 10th year, we will also get the face value of the bond back. For 9 years, we are getting only interest, that is 101.5. In the 10th year, we are getting 10th year's interest plus principal amount of 1000. So let's find out what is the yield on this bond. The yield on this bond can be found out using a function called XIRR. XIRR. Select all of this, the cash flows. select all this dates, and you will get 10.14 as the yield. Remember, this is very close to what we have seen here, 10.14 as input. At this moment it is fine. So let's find out, but remember this 101.5 is taxable. According to personal income tax laws, any interest income is a other business income. You will be treated as other income, not business income. Will be treated as other income. We know that there are 5 heads in personal income tax, and amongst that an interest income will be taxed under other income, and other income will be taxed at an individual's marginal tax rate. An individual's marginal tax rate, that is whatever is his tax slab, he will be taxed on that. So we have assumed that our investor is going to be taxed at 30%. So he has to pay 30% tax on this coupon of 101.5. Whereas in a tax-free bond, the REC tax-free bond, whatever coupon he receives, he need not pay tax on that, right? And hence, to compare this bond with a tax-free bond, we have to reduce the tax that this investor will pay. So, and find out this yield of 10.15, equivalent of this 10.14% yield, so that a tax-free bond and a taxable bond can be compared. I quickly repeat. So, this incomes are taxable at the rate of individual's tax slab. So to compare it with a tax-free bond, we have to subtract tax from this coupon, so that a tax-free bond and a taxable bond becomes comparable. So let's find out the post-tax yields of this bond. So you still have to buy this bond at 1,000 rupees. However, the post-tax coupon that you will receive will be 101.5 into 1 minus 30%. Why do we say so? So remember, if you receive 101.5 as coupon and pay 30% tax, you are likely to pay 30.45 as tax. So you received 101.5. Amongst that, you paid a tax of 30.45. So your net income, net post-tax income is 71.05. That's what we have found here, which is 101.5 into 1 minus tax rate, right? So once you find this, so for the first 9 years, you will receive this as post-tax yield, that is 71.05, and the 10th year you will receive 71.05 plus the face value of 1,000. Now let's find the yield on this bond, which is XIRR into the dates. So there are two arguments to this. One is XIRR, two arguments to this. One is values. The values are the post-tax cash flows, and the dates on which those cash flows occur. Once you do this, you will get the post-tax yield. So on a post-tax basis, you are likely to get 7.1% yield. The REC bond, if you remember, we saw gives a post-tax yield of 8.26%. The REC bond gives a post-tax yield of 8.26%. So if you see that, if you put it here, so you can clearly see that we are going to earn 1.16% additional income, additional yield. So on a post-tax basis, an investor who has 30% tax rate is likely to gain or earn 1.16% extra, right? So clearly this tax-free bond looks attractive given the current yields. There are two interesting points that you may notice here. This 7.1% can also be found by the post-tax yield, can also be found by 10.14%, which is the pre-tax yield, into 1 minus the tax rate, which is 30%, which is also 7.10%. So this and this are equal. Instead of doing this lengthy process, you can also do pre-tax yield into 1 minus 30%, that is tax rate, which is 7.1. Remember this relationship that I spoke here, that is pre-tax yield into 1 minus tax rate, will hold good only for par bonds. This will not hold good for discount bonds. This will not hold good for discount bonds or premium bonds. This will not hold good. What is a discount bond? A discount bond is, let's say a bond has a face value of 1000. The face value is 1000, whereas the current price is 900. So if a bond is trading at a price that is lower than its face value, then it is called discount bond. Similarly, the face value is 1000 and current price is 1100, which is greater than face value, then it will become premium bond. So in this case, if the face value is 1000 and trading price is 1100, it becomes a premium bond. Since this is a fresh issue, we are going to get the bond at face value, and hence this problem does not come. So we can directly work out with the formula that we have discussed so far, right? So what you can do is, to find out this post-tax yield, you can do pre-tax yield. The formula you should use is pre-tax yield into 1 minus tax rate. What we have done is 10.14% into 1 minus 30% tax rate, or 10.14% into 70%, which gave us 7.1% as post-tax yield. So a benchmark bond or a taxable bond gives post-tax yield of 7.1%. A taxable bond gives a post-tax yield of 7.1%, whereas a tax-free bond gives a post-tax yield of 8.26%. So by investing in a tax-free bond, an investor gains 1.16% more, right? So that's why probably you should consider investing in this bond. While we are not recommending or de-recommending REC bond, this is how you have to analyze a tax-free issue. Let's quickly look at how we can go about doing the same analysis for various tax slabs of investors. Now the 30% tax slab that we assumed is a too simplistic an assumption. An investor can have 10% slab, 20% slab, 30% or 35% if he is a corporate, right? The pre-tax yield for investor does not change. A pre-tax yield for an investor always remains at 10.15%, right? So let's find out what will be the post-tax yield for this persons. Let's find out what will be the post-tax yields for this person. So the post-tax yield, as we saw just now, is going to be 10.15% into 1 minus the tax slab. 10.15% into tax slab. So for a 10% guy, it will be 10.15% into 90%. What I am doing here, I quickly repeat. What I did is pre-tax yield into 1 minus tax slab. So I did 10.15%, which is the pre-tax yield, into 1 minus tax slab. That is 10.15% into 90%. So now similarly I can do it for other tax slabs. So for this tax slab, 20% tax slab, it is 10.15 into 1 minus 20%. For this tax slab, it's 10.15 into 1 minus 30%. For this tax slab, this is 10.15 into 1 minus 35%. So if you see here, these are the post-tax yield of a taxable bond. Whereas the tax-free bond gives 8.26% for retail and 8.01% for corporates. So you can clearly see the arbitrage here. The additional yield in tax-free bond. The additional yield in tax-free bond In this case, for a 10% tax slab guy is minus 0.88%. For a 20% guy, it is plus 0.14%, or he should be ideally neutral. Whereas for a 30% tax rate person, it is 1.16% additional yield. For a corporate which pays 35% tax, it is 1.14% additional return. So as you can clearly see here, so this tax-free bond makes sense only for investors with tax rate of 20% or above, because for a person with tax rate of less than 20%, he actually will not make any extra money by investing in a tax-free bond, because he is anyways paying lesser tax. So this bond, tax-free bond, is suitable only for persons who are paying a tax of more than 20% or more. In fact, at 20% he is almost neutral. At 20%, his yield is only 0.14% higher in a tax-free bond. Whereas at 30%, his yield is 1.16% higher in a tax-free bond. At a 35%, his yield is 1.14% higher in a tax-free bond. So as I said clearly, this is the analysis that you have to do, and this clearly shows this tax-free bond is not good for everybody. This is good only for persons with tax rate of 20% and above, right? So finally, one minor point that you may want to note here, for 35% tax rate, I have put an yield of 8.01%, whereas for others, I have put an yield of 8.26%. The reason being, this is the yield that is available for corporate. For example, if you see here in this note, 8.01% is the yield available for 1A. The 1A is accessible for corporate and 1B is accessible for retail. So 1A will get an yield of 8.01% and 1B will get an yield of 8.26%. That's why I have put for 35% tax rate is applicable only for corporate. So that's why I have put 8.01 here. But irrespective of that, this bond is attractive for investors with more than 20% tax rate. So this is how you have to assume. Thanks for watching this video. Once again, we are from FinSiksha. We offer training for wealth managers. If you are interested, please contact us. Please send a mail at contact@finsiksha.com. Thank you.